Hey everyone, Richard Norris here, and in today's video I want to talk to you about the impact that rising interest rates are having on the buy-to-let property market, in particular in relation to 1-bed, 2-bed and 3-bed type properties where we're renting them to single families or single professional people as an example, and we're just renting out on a standard buy-to-let model. Now at the moment, obviously we're in a recession, interest rates are rising, a lot of people are asking now, should I be investing in property? Is now the right time to be getting into the buy-to-let market? Or has the buy-to-let market had its day and therefore it's no longer a valuable commodity to invest in? In today's video, I'm going to share with you my screen. I'm going to go through a number of calculations with you, and I'm going to show you that buy-to-let is actually still a valuable commodity to invest in. We're going to go through the granular numbers. My input on property and my perspective on property is that numbers tell the story, and I only ever make my decision based on data. So today we're going to look at the numerical data, we're going to go through some spreadsheets, and I'm going to show you the exact calculation that you need to be thinking about when investing in buy-to-let in today's market where interest rates are rising to around 6%. So without further ado, let's go into my screen where I'm going to share with you everything to do with buy-to-let numbers and the impact that interest rates are having on the market. But before I do that, just in case you don't know who I am, my name's Richard Norris. I've successfully built a multi-million-pound property portfolio, and my group of property companies does over £200,000 a month. Now, if you're new to my channel, make sure you hit that subscribe button, and if you like the video, please hit the like button as well, and also ring that bell so that you can be notified when I release new content. I'm currently releasing content around 2 times per week at the moment, okay, twice per week. So let's jump in, let's get into the numbers, and I'll see you in a second, and I'll talk to you about how to be adaptable. The key right now in the market is to be adaptable to the up and coming changes that we see in relation to rising interest rates. Okay, so I'm going to say that word again. You're going to hear me say it a lot throughout this video today. It's all about being adaptable. As a property entrepreneur, you must be adaptable, you must be flexible, and you must not be rigid in your approach. And to be completely transparent with you, I think a lot of people right now have a kind of a distorted view on the property market, because from a high level there's a lot of fear, there's a lot of stuff we hear on the news about interest rates rising, and it's all doom and gloom, and all of that fear is stopping you from going out and taking the decisions and actions that you need to make in order to thrive in this economic downturn. Okay, there's people that will thrive in a recession, and there's people that unfortunately don't do very well in a recession, and I want you to be one of the people that thrives, which is one of the reasons why I'm creating this video. So without further ado, let's jump in. I'll see you in the numbers. Okay, so let's jump into the numbers then. So this is one of the spreadsheets from my training program, Property Investors Accelerator, and I'm going to go through the granular details here. One of the things that you're going to get to know about me, if you don't know me already, I'm a big fan of like going granular, going really deep. I honestly believe that the property market, everything that you see on the internet, I think is very high level. And what I want to show you today is the granular depth of the numbers so that you can really understand the mechanics of how all of the different things like yield, your loan to values really affect your return on investment as a property investor, and really about, like I say, that key word about being adaptable and how to manipulate and make changes so that you can understand the patterns that the cause and effect relationships in the numbers when you're working out your property deals have on you as an investor. And that's going to help to keep you safe, especially in today's market where interest rates are rising. And it's going to show you that actually like things are still very profitable if you know what you're doing and you know how to view this in the right perspective. So with that said, let's jump in and go through the spreadsheet and the numbers. So the deal that I'm basically going to share with you today is an example of a recent deal that one of my clients have just done, okay? And it's using the buy-to-let, buy, refurbish, refinance, repeat model, otherwise, as you probably heard, called BRRRR, right? So let's go in and look at the guide price. So the first thing we do is we enter the guide price over here, right? So this property was on the market. It was a 2-bed terrace property in a place called Merthyr Tydfil in South Wales, and the guide price was £85,000. My clients happened to pick the property up for £76,000, which means that the deposit at 25% is £19,000, the mortgage at 75% loan to value is £57,000, the solicitor's fees are £1,500, and then we have like our broker fees and valuation. Now, when we look at the broker fees and valuation, the broker fees we're allowing $499 for a broker application fee. Sometimes you can get this for free depending on the broker that you use. And then we're going to look at like the valuation. So things like do you need a structural survey report? Is there any asbestos reports? Or simply, do we need a professional valuation? And if the lender isn't throwing it in free of charge, which sometimes they do, this assumes that we allow sort of £850 to allow for any kind of contingency for like any professional valuations that we need. So that's what comes to £1,350. We have the stamp duty at 2%. Now, the stamp duty is currently, this should say 0 to 250 because the recent budget changed, and at the time of this recording, there's no stamp duty to pay between 0 and 250 on the first 2%. You still do have the 3% surcharge though as a buy-to-let investor if you have an additional property, and therefore we take the 3%, which is 3% of 76,000, the purchase price, and we get £2,280. So this spreadsheet that you're going to see, a lot of the calculations are automated in the background for like efficiency, and you're going to see why this is really good when you're an investor and you're trying to look at and establishing different market variations, because the property market doesn't sit still. So you need to be adaptable again. You need to know how to basically circumvent the market, and you need to know what sort of interest rates, the changes in interest rates, the fluctuations that we see in the market can have on your numbers at any given time. If you're able to do that, fundamentally, buy-to-let property is always going to be a valuable commodity, because house prices are always going to go up in value over the long term. Yes, you will get fluctuations, you will get peaks and troughs. That's normal with any market where you're an investor, but property has stood the test of time. And if we go back and look at history and look at data, and we start to base our future decisions based on past numerical data that we can substantiate, property over the long term goes up, and there's no argument to that. That's just a fact. That's just what data says. Over the long term, if you hold property long enough, it makes you wealthy in the long term, because of the appreciation of your asset. Now, the next thing we have to look at is like the project hold cost. So this was a 2-bed terrace property. It needed a bit of tender love and care, a bit of TLC, and also what my client did is there was a massive bedroom, which was bedroom number 2. They simply just put down a stud partition in the middle to separate it into a 3-bedroom property. So now what we have to do is say, well, during the refurbishment stage, whilst we're doing this property up, we have some hold costs. Now, what are those hold costs? So for example, you can see here that it's £57,000 is like the 75% loan to value. So notoriously, when you're buying a property as an investor, the minimum that you can put down as a deposit is 25%. You have to put in at least 25% and get 75% from the mortgage lender. You can of course change that loan to value based on your personal individual requirements and your personal subjective situation. Now, for the purpose of this video, I know that interest rates aren't 3.5% right now. I know that roughly in the market, if you're buying in a limited company, interest rates are between sort of 5 and 6%. However, I just want to show you like the differences of what it used to be. If we are buying this pre-interest rate rise, this is what you would see. I'm going to show you as we go throughout this video today, and as we go through this training video, and as we go through this spreadsheet, I'm going to show you how you can look at the true numerical data at 5 and 6% as well, because the spreadsheet takes into account all market variations. So I want to kind of give you the lens at buying like what it was previously, and then I want to show you what it is now. So you can see the difference and the slight decrease in profit margin, but you can still see that the overall investment is still very profitable, which is the point that I want to highlight to you today in this video. And just like I say, show you how to be adaptable and show you how to be able to manage the numbers in a market so you can thrive during a recession and not be fearful and sit there and do nothing, which I think is what a lot of people are doing right now. So 57,000 at 3.5% interest would mean that the mortgage would be £165 a month. We allow £20 for gas, £20 for water, and £20 for electric. I'm just going to pop myself over here so you can see this. Now, in terms of like council tax, like depending on the area that you're investing in, so like this one's in South Wales, there is no council tax to pay if the property is not in a habitable condition. So if it has no kitchen, no running water, at that point we can go to the empty homes offer and apply for basically council tax relief. So on this property, that's what we did. And therefore, the project hold costs of my client for this particular deal are £225 per month. And if we times that by 3 months to do the refurb, 8 weeks to do a 12k refurb with a month contingency for overrun of time, but also allow for a month to get tenants in, we're at £677 per calendar month whilst we're doing the project refurbishment, and these are our hold costs. So with that said, that goes in there. There is no sourcing fee. My clients found this on Rightmove. They were able to negotiate 9k off purchase price, and I think there's going to be a lot of discounts like this to be had, more so when the market is less attractive to new investors right now. And actually, because of certain changes which I speak about in other videos on the YouTube channel and current market conditions, means that it's a favorable time for us as investors to go in and actually negotiate and get sort of deals from motivated sellers, because there's going to be a lot of distressed existing landlords in the market that want to leave, people who haven't done their numbers right, accidental landlords that think that property is too much hassle for them, they're not running it as a full-time business like ourselves, and therefore they're leaving the market, and therefore they become sort of motivated, and therefore we can basically go in and negotiate a discount on day one. Now, in terms of the refurb was £12,000. So as soon as I put that in, you can see here, if we ignore the angel investors for now, this deal cost you £36,807 to do this deal, which is a combination of the deposit of £19,000, solicitors fees, broker fees and the valuation, the stamp duty and the project hold cost and the refurbishment cost. So all in to do this deal, it's just going to cost you £36,000. Now, the new market value, when my clients went back to the lender and they said, can we come and refinance the property now to pull some cash out, it got valued at £115,000. Now, as soon as I put this in, you can see lots of changes happen. And basically, this is the beauty of these spreadsheets. They're all automated, so they do the numbers for you and they do the hard work. So if you're somebody who struggles with the numbers slightly, then these spreadsheets are going to be great for you. But let's say that the market value is $115,000. The maximum new lending therefore is $86,250. That's 75% against 115, and therefore the equity is $28,750, which is the difference between the 115 and the $86,250 here. Difference between the done up value and your new maximum lending is your equity. Now the money out is $29,250, and the way that we work that out is we take the $86,250, we pay back the original mortgage on day one of $57,000, which means that we take $29,250 back out of that property and into our bank accounts, meaning we only leave £7,500 in the deal. Now, this is the real interesting part over here, right? You're going to see the difference. If I were to buy this property pre-interest rate rises and I'm getting 3.5% in a limited company, this is what the numbers look like. And if I'm buying it now in today's market with interest rate hikes at around 5%, then I'm going to show you what that is as well. Then overleaf in this spreadsheet here, which I'll turn to in a second, you're going to see what impact the interest rate rises have at 6 and 7% as well. So you can clearly see the margins and the impact that interest rates are truly having on your bottom line as an investor. So the rental income for this property is 675. Now, as soon as I put 675 in, you can see that the mortgage at 3.5% is 250. The management fee at 10%, 675, take 10% for your management fee. If you're getting agent renting it out, it's 67.50. And your monthly operating expenses, we always allow 10% of the gross rental income, the 675, for basically your maintenance, your small wear and tear, and some of the things you have to do as an investor, like builders and contents insurance, and maybe like your annual pack testing and boiler service. Now, ground rent and service charge is not applicable to us as an investor if we're buying like a 2-bed or 3-bed terrace property, if there's no lease and this is a freehold property. The gross profit therefore is $289 a month. So just under £300 profit, which is your 675 minus your mortgage, minus your management fee, minus your MOE, gives you just under £300 of profit. Now that basically means that your return on investment is 46%. So pre-interest rate rises, this deal would have made you a 46% return on your investment, which is the 289 times 12 to give you a annual net cash flow. And then you divide that by the money left in to give you a 46% return. So this is saying if you had £7,500 in your bank account, you're making £290 net cash flow, net interest per month, 46% interest a year on that bank account. So this is a great property deal, right? It's clearly a good bank account. If this were a bank account, you'd want to put your money there. This is also tax-free as well. And if you don't understand how it's tax-free, it's like utilizing directors' loans accounts. And again, if you go into my videos on my YouTube channel under the property tax section, under that playlist, you'll find lots of videos about how to invest in property tax-free as a smart property investor. Now, let's take a look at what happens with the interest rate rises. So that we can see pre-interest rate rises, this deal is making us 46% return. And now interest rates are at 5%. What does the deal look like? Well, our mortgage has gone from $250 a month to $359. So we're paying an extra £109 of cost on our mortgage. So our mortgage is more expensive because of the interest rate rise and the fluctuation. So if we were to do this deal today, we're not making $290 a month, but we're only making £180. But I say only, the ROI is still 29%. It's still an incredible return. If you're making 29% return year on year tax-free during a recession, like guys, honestly, like you're winning. Like there's nothing to be worried about. This is what I'm trying to say to people. This is my point, and this is my perspective, that yes, interest rates have gone up. Yes, we can see that it's not as profitable as what it was at 3.5%, but this is still a very profitable commodity based on interest rates today, based on market conditions, and based on other investments that you can make. I mean, this is a solid bricks and mortar, tangible. You can touch it, you can feel it. If you hold it long enough, it's going to asset appreciate over the long term, so it's going to go up in value, and you're making a 29% tax-free profit. Like, in my opinion, it's still a solid investment based on the numerical data that we see in front of us. Now, the reason why this deal works very well, I'm just going to pop this over here now. The reason why this deal works very well is because of the yield. You can see that the gross yield here that's been calculated by the automated formulas that I put into the spreadsheet, you can see that the gross yield is 7%. Now, this is an important metric to track. If you want to basically still make profits at 29%, 20%, 15% plus ROIs, and you still want to make like £150 plus of net cash flow a month on your buy-to-let deals, then your gross yield needs to be 7% plus. So this is like the worst case, because if the yield on this property was 8%, you'll see that the ROI would be higher. And I'm going to show you that change in a second and how to manipulate this. So again, you can see the correlation between the yields, the return on investment, the rising interest rates, which is what this video is all about. It's how to basically make sense of things rather than getting caught up on emotion that interest rates are rising, I should be panicking, we're in a recession. Rather than thinking and focusing your reticular activating system on the fear that kind of paralyzes you from making decisions right now, I'm saying, hey guys, relax, take a look at the numbers. What is the numbers actually telling you? What does the data tell us? And that's kind of like been a really like big hack for me that's helped me to become a multi-millionaire at the age of just 32. By basically making sure that every decision that I make is based on numbers and data. I'm trying to get rid of any emotional association to my decision-making process, right? And I'm trying to basically filter out from my ROAS, my reticular activating system. I'm trying to filter out any noise. And honestly, right now, there's a lot of noise going on in the market if you're watching the news, and it's all like very doom and gloom, right? But there's a lot to be positive about. You just need to refocus your ROAS on the actual data and the numbers. And when you can map out your deals like this, you'll see that in property right now, it's still a valuable commodity. It's still a strong asset to invest in when you're making sort of returns of 30% net and no taxes to pay on that, right? So with that being said, like, we'll manipulate this to 8% yield in a second. You can see what that does on the numbers. But with that said as well, like, this doesn't also calculate the total return. The total return basically assumes that this is my net cash flow. This is what I'm making per year just on cash flow. But what happens is we need to allow for our capital growth as well, which is called the total return formula. And that basically allows for capital growth plus cash flow. And the way you work this out is we're going to assume, now on average over the whole of the UK, property prices appreciate by 7.5% per year. I'm only assuming on this deal a cap growth rate of 3%. So I'm basically saying if this property is now valued at 115,000, in 1 year's time, I'm assuming that this property goes up by 3%. Now, even if it doesn't go up by 3%, I'm still making my 29%. I'm still making my £180 a month cash flow. Rule number one is the property must pay you every month with predictability. If it's in the right location, you've got product market fit, you've got a strong rental demand, we can guarantee on these numbers that we're going to make £180 gross profit as a worst case scenario, year on year, tax free, if you know what you're doing and if you're doing it tax efficiently, right? So this is just like icing on the cake. This is just like an additional upside of investing in property. So let's say that it went up by 3%. That basically means that the 115,000, if it appreciates at 3%, the capital growth amount is 3,450. The way you work that out, you take the 115 times 3%, you'll see it's 3,450. And then the annual net cash flow is £2,167.50. That's taken from your £180. I'm using the 5% here, which is today's interest rates. Take the £180 times by 12 gives me £2,167 per month. Therefore, my total return, if I add these two numbers together, the cap growth amount and the annual net cash flow, I arrive at £5,617.50 return year on year tax free at 74.3% return. That's a phenomenal return, especially when you say, hey, this is the worst case. This is like right now, interest rates are high, base rates gone from 0.25 to 3%. I'm paying 5% in a buy-to-let company to buy a normal 2-bed, 3-bed terrace property, and I'm still making a total return of 74% on my money. Like, this is what makes me substantiate and be able to sit here and give you so much conviction and confidence with certainty and tell you that property is still a valuable commodity to invest in despite interest rate rises, right? And what this shows us up here is it tells us what the new house price is going to be as well, which is £118,450, right? Which is your 115 plus your 3% cap growth rate, which is the 3,450 on top. 115,000 plus the 3,450 gives you 118,450 is the new house price, plus £180 a month of net cash flow year on year compounding. This doesn't even calculate the compounding interest of it keep going up at 3%. So if we said in year 2, 118,000 times 3% gives us another uplift. It doesn't even include for that. This is like your worst case downside calculation of, hey, if all I do is make net cash flow, this is my return. If it doesn't go up, if I make net cash flow of £180 a month plus a minimum cap growth of 3%, this is what the picture looks like without compounding it all up. Now, before I show you like how to manipulate this and show you what the gross yield has and the impact that lower yields will have and how to basically get this number higher by reducing the loan to values, I'm going to show you what happens at 6 and 7% over leaf. So if we go over here, if the interest rates were 6%, so if basically the mortgage term end and we are forced to pay 6% interest rates on this deal, we're basically making an ROI of 17% and a gross profit of £108 per month. And if interest rates would go to 7%, we're still making £36 a month and 6% return. Now, this allows for contingency. This gives me my contingency at 7%. It allows for another 1.5 to 2% increase in interest rates if interest rates would go to from 5 or 5.5 to 7, right? And even like here, okay, it's not the biggest profit in the world, but at 7%, if you're still making profit, you're still in the game. It's still a valuable commodity. The commodity is going up. It's not going to stay at 7%. You are eventually going to get interest rates back at 6, then back at 5, and then maybe, who knows what the future holds. Maybe we'll see 3.5 to 4% again in the future. So if you look at the whole deal and take into the whole perspective, you can see that the spreadsheet, the deal analyzer, takes into account every single variable, and this shows you basically the impact that interest rates are having and why like it's important to make all of your decisions on the data, because this is what gives me confidence when I'm making my investments. Now, with that being said, like let's take a look as well, like what happens if we reduce the loan to value. Let's say, for example, you want to make your gross profit higher than £180 and you want to make it say 250 to 300. That's the variable that you're working towards. All you need to do is change the loan to value from 75%, and you could reduce your loan to value to say 65%. If you reduce the loan to value to 65%, you still make 14% return, net return, free of taxes, 14% at £228 per month with a 65% loan to value. So one of the ways that you can invest now, and again, this depends on your subjective situation, where you're at in the property cycle, in your own property journey, and how much money you can afford to leave in the deal. But let's say you can afford to leave 19,000 in the deal and you can tie that up. You could go at 65% loan to value and make a 14% return because you're increasing your gross profit. If you reduce this to 50% loan to value, for example, you can see again that you can make a gross profit of £300 per month. So £300 per month for a normal buy-to-let property is currently what you'd be making roughly if you were investing pre-interest rate rises. Anywhere between 250 to 300 on a 2-bed terrace property is standard for a buy, refurbish, refinance on a sort of 2-bed, 3-bed terrace property. 250 to 300 is what you'd expect to see at the 3.5% level. So that basically what this is saying, in order to get the same metrics as before pre-interest rate rises, you would just reduce the loan to value to 50%, which means that you would tie up 36,000 in deal. Yes, you make a lower return, but your cash flows and your margins are still there, still very healthy. And you can see that basically you still make your healthy margins, right? Now, if we were to do this at 6% and you were to change this to 50% loan to value, okay, so change these both to 50% loan to value from 75. You can see at the 50% loan to value at 6%, you make 252, and at 7% you make 204. So again, you can just manipulate numbers, the spreadsheet, to massage the manipulation in what you decide to do. If I reduce the loan to value on the property, what does that do to my numbers? There's 3 things you can do in the market right now. One is to reduce your loan to value. The second thing you can do is to force the appreciation more by doing bigger conversions and basically forcing the yield higher. And the third thing you can do is just to do a normal standard refurb on a buy-to-let terrace property, but make sure you're investing in areas where the gross yield is between 7 to 8% and you'll still make healthy cash flows, and buy-to-let will still work for you even based on today's interest rates being slightly higher than we've been used to in the last few years, where we've been used to very, very low interest rates, right? So hopefully this shows you and demonstrates to you like exactly how you can invest in the buy-to-let market today and what you can do, and that there is still margin, there is still certainty within the property market despite interest rate rises. When you map out your numbers like this, you can still see that there's profit to be had, and you can still see that you can make very good returns. So just want to show you what would happen if the yield was lower. So the problem arises basically at the higher interest rates when the yields are lower. So let's say that the property is 115,000, but the rent was only 500 as an example. You can see that the profit drops and you only make 5%. Even at the, say, if we change this to 75%, let's just change this all back to 75%. So again, we can see 46% at 3.5, and we can see if I change this back to 75% as well, which is here, 75% loan to value, rental income is 675. So pre-dropping the yield, if it's 675 and we're still at 7% gross yield, we're making £180 and 29%. If the yield goes down at 75% loan to value, if the yield drops, if this yield isn't 7% and we start to see like maybe 6 or 5 to 6%, so that's only £500 gross rent. So therefore, at £500 gross rent, if we take the gross rent of £500, we have the yield of effectively what we've got is we now have the gross rental income, which effectively should be, where's my formula here? I'm just tracking something. The great thing about doing deals live, right? Okay, so it's tracking 675. So I need to change it there. So basically, if I come out of that, if I change again the yield to 500, so it drops the yield, sorry, here's my point. At £500, you can see that if the yield's only 5%, you can see you're only making 6% at 5% interest rate. 5% interest rate, ROI went from 29 down to 6 just based on the yield, okay? If I change this again to 675, and I put this back up to 675 as well, so back up to the 7% yield, you can see we've got our margin at 29%. So if you're investing in like the southeast of the UK, like places like Oxford, London, anywhere south of Coventry, you're going to see that the lower yields are going to squeeze your margins at 75%. So you'd have to, one thing you could do is reduce the LTV right down, so loan to value from 75 to 50, as I just showed you previously, even on the higher yield. And then if the yield drops, the other thing that you can do is you can just look at, you could basically say that, well, actually, if I'm happy with 6%, I'm only investing for capital growth, which is a risky strategy, but that's another thing that you can do if that's your specific model. But hopefully this makes sense. Hopefully it tells you and shows you exactly how you can manipulate the market and analyze your buy-to-let deals using the spreadsheet. Listen, if you want access to this spreadsheet, right? If you want access to this spreadsheet, I'm giving it away. I've created a free mini training program for people so that they can get started in the property market. I have a free group, a new free group that I'm introducing over the next 3 to 4 weeks. If you want to have access to that free mini training, just comment yes in the comment section below this video, and I'll send you the link. I'll comment underneath and I'll send you the link to the free group in 3 to 4 weeks time, and you can have access to this deal analyzer and the free training as well, which I've created for you. Okay, now with that being said as well, if you're somebody who wants to get into the property market right now, this video has given you confidence that there's still deals to be done in today's market, and that actually it's not as bad as you thought, and that actually there is still margins and good ROIs even at 5-6% interest rates on, to be honest, the least profitable strategy in the market right now, which is buy to let, and you want to get started in property and you want to have the right guidance from myself, my team, and you want an opportunity to work with us to see if you're a fit for us and we're a fit for you, then click on the link below in the description section. Click on the link that says book a call. You can book in a free consultation with my team. We'll see if you're a fit, and if you're a fit and you want to get started, then we have a few spots left, and I would invite you to my program, Property Investors Accelerator, and we can see if we can make things work and if we can work together to help you grow your property portfolio so that you can be profitable and that you can dig for gold, basically when the masses are fearful, right? And you can basically be one of the people that's going to thrive during a recession, and basically invest even when times are during a recession where there actually is opportunity, where most people think that there isn't. Hopefully this video shows you the opportunities that are still left in the market and shows you that the right thing to do right now is to take more action. Whenever a recession, whenever there's a downturn, actually take more action. And honestly, like Warren Buffett says, like, be greedy. And right now it's your time. It's your time to be greedy, to be honest. You need to go after it to basically secure your family's financial future. This is exactly what I'm doing. It's what my clients are doing. This is how we're analyzing deals to keep ourselves safe, to keep our investments safe, and to make sure that our wealth continues to grow even during recessions. Okay, so if you want to work with me, click the link below, schedule a call with my team, and hopefully we'll speak soon. Again, if you like this video, just please hit the like button, ring the notifications bell, subscribe to the channel if you haven't already, and I'll see you in the next one.